Good morning. You're watching The Market right here in 18 now with me, Ayesha, Faridi, Nikunj, Dalmia, Avanne Dubash in the studios. And coming out of a truncated week with a lot of news flow to react to. Firstly, just a glance back of how the week went by was. And we managed pretty okay in the last 4 trading sessions. While on a net basis, we may have been quiet on the Friday, but over the week, we managed to gain about 2.5%. Net result, we're comfortably above that 17,800 level, and we managed to now gain for 3 consecutive weeks. In fact, it's the largest or rather longest winning streak that one has seen in the last 30 months. But I guess IT is going to spoil the party today.
Aisha, longest winning streak in the last 30 months means that this is one of the biggest winning streak we've seen actually post-COVID.
Yeah.
And it's quite amazing that what a comeback it's been. It may not be like a fantastic comeback in terms of the mid and the small cap stocks, but yeah, it's been a very good comeback. It was largely supported by reversal in flows and the fact that globally markets are no longer worried about what is happening with some of the regional banks now. I think there is still upside left in terms of where the near-term trends are. While IT may spoil the party, but the upside which will come from banks will ensure that the two wheels, in a sense, are balancing each other. The participation is still very low. The average Joe on the street is still feeling that this market is not going to sustain. So I would continue to remain optimistic in the way how markets should move in the near term. But yes, IT is now in that spot where everyone is saying that is this like a reversal of, let's say, what we saw in 2008 or in 2012-13. The kind of indications what we've got from Infosys, which we'll discuss separately, is a clear indication that bad will get worse before it will get better.
Yeah, it's pretty much going to be a tug of war, I guess, between Infosys on one and HDFC Bank on the other today.
Yeah, but Infosys, if you look at standalone, what has gone wrong? Uninspiring commentary. A quarter ago, you've come out and you've increased guidance, and then you come out with results which are even way below the most conservative estimate. The forward-looking comments, even though what they're talking in terms of FY24 numbers, versus what they actually have delivered for the quarter gone by, it just does not inspire any kind of confidence. So the turn what Infosys spoke about, and if you do a relative comparison of TCS versus Infosys has been nothing short of an howler. And these numbers in a sense just raise question mark that has the management got their assessment of the business cycle wrong, or this is just a volatility which will pass through. So I'm not at all surprised with the kind of brokerage downgrades which have come out from 10 to about 15%, 10% being the average and 20% being the highest. That is the kind of cut what brokerages actually have come out with. And this is a very well owned and a very well tracked stock. Now on that kind of a stock, if the miss and if the brokerage downgrade is so large, it just tells you that analysts were completely on the different side of the fence, so to speak. I mean, and when the markets are surprised, in this case, when they are shocked, it will lead to a massive derating in the stock in the near term. If you frankly look at Infosys, it has been the better performing IT stock. It has not fallen the way Tech Mahindra or HCL Tech has fallen. So, A, the outperformance will now be challenged. B, derating will start. And third would be the weightage what it has on the Nifty will have an impact on benchmark indices.
But don't you think, Nikunj, to a certain extent, TCS was a bit of a precursor as to what we may expect, or was Infi a complete shocker on the downside?
No, Infosys has been a complete shocker, Avanne. And I'll tell you why, because along with the Q3 numbers, they came out and they increased their guidance. And Q4, and you completely, change the commentary and you change the numbers completely. So you got to ask yourself is that what has changed in between that quarter? And what
how did you not see it coming?
Exactly. Yeah. And even if you, let's say, even if you did not see it coming because what was happening with US regional banks, you would say that, is this just an extension of the bad news? Because there is no guarantee that by end of this quarter, things will actually start looking up. I guess from a market standpoint, and what our viewers they need to understand is one simple thing. IT companies will go through their bad patches. How is this different from 2000? How is this different from 2008? And how is this different from 2013? If this is a slowdown of 2023, is this going to last for 2, 3, 4 quarters, which historically all slowdowns have lasted, or this is just a passing phase where the drop has been unreal and the comeback would be also V-shape? Will it be like that COVID kind of an situation where the drop is very sharp but the comeback is real?
This is in some sense also a transitional phase, right? The world is moving towards AI, and that's the commentary from most of the IT majors, that it's AI that they now have to look into.
See, Ayesha, their deal wins have not been bad.
Yeah.
So if you think about it, that while clients are going easy in terms of spending, in terms of their bringing the entire decision making back, the deal wins have not been that bad. That makes me optimistic that it is not as dire as what the world looked like, because the first impact would have been captured on the deal wins, which is not bad for TCS and Infosys. Also, the IT positioning is not that grand. It's gone through in 1 year of underperformance. So at some point in time, IT will become a classic contra buy, because you want to. There is a factor of buyback also which is at play. But I don't think we are there yet. The question what markets would much over now is that, will the bad get worse before it gets better? Are we now reaching the abyss in terms of contraction, or this is just a passing phase where 2 quarters later it's going to be back to square one or back to normal?
Yeah,
In fact, let's hear out what the management had to say explaining this kind of a performance.
In Q4, we saw changes in the market environment. During the quarter, we saw unplanned project ramp downs in some of our clients and delays in decision making, which resulted in lower volumes. In addition, we had some one-time revenue impact. While we saw some signs of stabilization in March, the environment remains uncertain. This led to our Q4 year-on-year growth of 8.8% in constant currency and quarter-on-quarter decline of 3.2%. Our operating margin was resilient at 21% for the quarter. We had $2.1 billion in large deals in the quarter.
All right, that's Infy. It was all in all a disappointing set of numbers, with the decline in their constant currency terms, revenue guidance as well being lowered, all being taken as a huge disappointment, as we discussed. But let's move on to the other big number then, and that's HDFC Bank that came out with its earnings on Saturday. And you have the NII and profits that did jump. You have lower credit costs, which did manage to cushion the rising OPEX. Asset quality as well improved, and the management in their conference call did say that the margins will remain steady despite the rate hikes, and that they will keep building on their branch network. Deposit growth as well, due to new liability relationships, is likely to grow. So Nikunj, how are we to look at HDFC Bank's numbers? It was a little bit of a miss on the operating profit front.
Look, they are not like real rara numbers, but these are okay numbers. They are unlikely to have a collateral damage per se on those. Remember, the stock now is almost at a 52-week high. Large part of the underperformance in HDFC Bank, that is actually behind us. But markets, I guess, now in the near term would be all about the proposed merger date. That's where the management has given you crystal clear commentary in terms of where and how the merger is likely to move, in terms of timeline. So I think that is what will make market excited, at least in the near term. In terms of growth, impressive. In terms of CASA, still very impressive. Operating profit are also a function of a lot of other levers. I don't think there is a problem per se in terms of the basic operating line. For me, what really matters is, in the near term, what is the challenge for banks? It is fight for CASA. And that's where I think HDFC Bank is gaining market share. And if they continue to gain market share, and if the merger goes through, the stock, which in a sense has been an underperformer for last couple of months, has now started outperforming. And it may continue in this phase of outperformance if money rotates out of IT back into banks. So there are very few large cap stocks where markets are deriving comfort right now. And money is going to move out of IT post TCS and Infosys numbers. And that money will go back to banks. And that's where I guess an underperforming stock like HDFC Bank is going to gain immensely.
Oh yeah, absolutely. That's the take coming in. HDFC Bank was just looking at the con call takeaways and how brokerages have reacted to HDFC Bank, stark contrast to the reaction in Infosys. And pretty much all of them maintain their buy or outperform ratings on HDFC Bank. Was just looking at Bernstein's note, and they are saying that Q4FY23 is pretty much meeting expectations and prepping for merger. EPS growth was limited on account of a flat net interest margin, saw spike in operational expenses with unchanged ROA versus what they saw in FY22, and they believe that it's going to be a healthy growth in deposits and continued pace of branch additions, which are key positives. So they've put a target of 2,200 on HDFC Bank. We're showing HDFC. We should show HDFC Bank stock price for you. 2,200 is at the target price put on HDFC Bank. Currently, the stock is at 1692 thereabouts. But yeah, good going. Let's welcome on board then Kunal as well. Lots to talk about. Kunal, hi, morning. Good week behind us, truncated one, well above 17,800, lots of earnings reactions. Not just that the 20% of Nifty weightage is about to come out with its earnings, but I think today will be a tug of war between Infy and HDFC Bank.
Absolutely, Ayesha. I think it's going to be a good week where the markets may probably digest the gains which we've seen over the last 3 or 4 consecutive weeks for many sectors as well as the indices. I think it's been a fantastic run over the last 2-3 weeks, coming out of extreme pessimism for the indices, a 1,000-point rally on the Nifty, a very strong outperformance coming out for the Bank Nifty. So, we are bound to hit, some sort of a zone of pause for the indices. We managed to scale past about 17,700, 17,800 as well over the last 1 week. So I think it's natural that we may probably consolidate at the 17,800 mark. I believe now broadly the range for the index could be at 17,500 on the downside and 18,000, 18,050 on the upside. I think it's going to be very interesting with the kind of mix of sectors which may probably get into a consolidation. So yes, largely the IT stocks may continue to drag specifically the large cap names, but then to offset the potential or the probable losses for the IT stocks, you might have the banking stocks which may tend to outperform. I think if I'm not wrong, HDFC Bank is just about 2% or less than 2% away from its all-time high levels as well. So I think there are a lot of large cap names which you've seen in the last 2-3 weeks, likes of L&T and now potentially even HDFC Bank, which are coming closer to their all-time high levels. That could probably keep the market sentiment a lot more positive than what has been maybe over the last 3 to 4 weeks.
Naresh, are we in for a week? Okay, no, it's not ready. So, Kunal, is it time to log gains then?
No, not really. I mean, for a short-term trader, if you've been buying index at lower levels, I think it's a good time to book out maybe 25-30% of the profits and then look to buy back on dips. So it's a zone where, we expect the markets to take a pause, but nothing materialistic in terms of meaningful trend reversal, at least I'm spotting as of now.
Okay. I just want to look at the Infosys ADR, and if we have it, what happened to the Infosys ADR? And that just fell like a rock from the top of the hill. The problem is not they have missed the mark, but the problem is that the narrative for Infosys, which was that they will continue to do better than the industry average, and they were on the path of recovery, which had started for Infosys, now reverses completely. Last 52 weeks, if you frankly look at Infosys versus TCS and compare that with Wipro or even HCL Tech, and we'll do that right now for our viewers. Why am I bringing that part out? Because Infosys and TCS, they've enjoyed this comfort zone. They've enjoyed this comfort zone in terms of what the markets are and where the markets could actually derive growth from them. So let's Infosys versus TCS for you. Infosys in last 52 weeks is down 14%. TCS is down 9%. But if you throw in a Wipro and HCL Tech in the same equation, in the same melting pot, so to speak, that is where the outperformance of Infosys would be visible. Look at Wipro, down 31%. And HCL Tech, it's recovered. Oh, I got it wrong. Tech Mahindra also has recovered after the change of guard, but Tech Mahindra otherwise has done rather well. So if you compare, let's say, Infosys with Wipro, or Infosys even with Tech Mahindra, Infosys has outperformed. And it had a reputation that it was getting its mojo back. Post the commentary and what they've guided for FY24, now even what they've guided will come under question. And that is where the re-rating happens.
Yeah, absolutely. I was just looking at the data points, stacking up TCS versus Infosys. Infy apparently in purely the growth projections has managed to outperform TCS for the last 4 years. Yeah. So, I mean, even with that valuation divergence that TCS always was in pole position, now that gap is only going to widen a whole lot. And Infosys exposure to digital apparently is higher than TCS. The North America exposure is at around 60%. So, things are only going to get worse.
No, Ayesha, Infosys post Salil's change of guard there, or his induction, has turned, he's managed to turn the ship around. And if you frankly look at what they've done in last 3 quarters, I'm keeping the last quarter aside, they've done better than the industry average. the path of recovery was visible, P multiple was expanded, they were getting the house in order. That gets challenged now. And markets would always say that what is that you've seen that you did not share earlier, which did not prompt you to you gave a rosy commentary when you came out with Q3 and you actually upgraded your guidance. What has changed in 90 days? Because it's a matter of 90 days. What has changed in those 90 days that you've come out and markets or your clients have forced you to change the outlook completely? I mean, what is that cyclicality? And I did not get that kind of a sense from TCS. Yeah. I doubt that that is something which is there in the system per se, in the environment per se. So is this problem slightly specific towards Infosys? And if it is specific towards Infosys, I think that derating has just about started. You put a 20% earnings downgrade or a price target cut by some of the brokerages. 10% is the least and 20% is the highest, and that's a serious downgrade for a stock which is owned and tracked by institutional investors.
Yeah, I mean the maximum price target cuts have come in from a Credit Suisse, for instance. They've cut the price target from earlier 1760 all the way to 1240 now on Infosys. If we can just bring up those graphics or get in that intraday chart. Nomura from 1660 down to now 1290. That's how steep the cuts have. Even the lowest of cuts amongst the brokerage fraternity are from an Investec, wherein the earlier target was 1685. Now they've reduced it to 1605, and Jeffries with an earlier target of 1770, which has now been cut to 1570. So even if you were to take a look at just the lowest cuts, they themselves are steep enough. But we'll talk more about Infosys. Got a whole host of experts as well to outline what is the future trajectory, not just for Infosys. If you're a shareholder, what is it that you should be doing, given that the ADR itself fell 11%, no less, over the last two trading sessions after the Q4 results were announced. And I think 8% was the kind of knee-jerk reaction in the first day alone. But Kunal, outside of Infosys, what are the stocks that you recommend trading today?
So, betting on individual stocks and on the strength of their charts. So, two buy calls. The first one is about Tata Chemicals. The stock again, in fact, the entire chemical space making a very strong comeback. Tata Chemicals verge of a breakout about this 1030 mark. So I think it's just shy by some 4 or 5 points from those levels. So would expect a breakout pretty soon for Tata Chemicals. Buy with a target of 1060. Stop loss to be kept at 1000. And Union Bank is the other stock which is also on the verge of a breakout. We saw very good recovery for the PSU banking stocks in the last 2-3 weeks. Union Bank is on the verge of a breakout about that 70 mark. So would suggest a buy 76 as an immediate target. Stop loss at 66.
All right, that's the view coming in from Kunal, betting on his top recommendations. But let's also hear it out then from Milind Karmakar of Dalal and Brocha Portfolio Managers. He talks about his take as to how one should look to evaluate pharma companies. Listen in.
Long back, when I say long back, it was in the 90s that I had met Dr. Reddy himself. And I was asking him that what should I look at when I'm looking at a pharma company, in the overall environment. And he had told me that time it's per capita income. The reason being that in India, the per capita income that time was so low that people didn't have enough money for their daily needs. So he said that unless and until daily needs are taken care of, no one is willing to spend on medicine, howsoever essential it may be. Things are changing now. And I think the rise in per capita income will be a key to success in pharmaceuticals. So besides, of course, the other things. So I think pharma is, and I have always believed that pharma is a sector which depends on rising per capita income, and because of rising per capita income, higher consumption. So pharma could be interesting over a longer period of time.
So between hospital and pharma, because you have exposure to hospitals.
Yeah, I have exposure to pharma as well. Okay. So we are bullish on both of them.
So one just buy a basket of MNC pharma stocks because they are a pure play on consumption. I mean, let's say whether it's a Glaxo or Aventis,
yeah,
they are pure play on Indian domestic OTC stroke the prescribed drug sales.
Correct.
Is that a better idea to buy?
So I could have a MNC pharma in my portfolio, but I think the domestic pharma have a few other legs as well. One of them being the exports. Okay. So that opportunity is not there in MNC pharma. So that is the reason why I would like to bet on an Indian quality pharma stock before taking a look at the MNC pharma stock.
Well, not just the market, not just IT, but HDFC Bank. That's where we are hoping a positive reaction from. Let's take it across to Harsh and dissect the numbers in greater detail. Harsh?
Well, yes, NIM steady state. What we're looking at is 4.1% on the NIMS front. NII continues to grow 24%. Healthy clip is where the NII grew at even in this particular quarter. The bit of a miss with regard to the numbers was on the operating profit side, largely led by operating expenses. 33% growth in operating expenses, keeping OPEX elevated, and that branch expansion that HDFC continues to embark on is what is putting pressure on the operating profit. So operating profit not around a 5% miss coming in on that number, but that has been knocked off by a very good piece on the asset quality front. So what we've seen is provisions have come in lower than anticipated, and the GNP ratio is in fact at a 23-quarter low. We're seeing credit costs at nearly a 6-year low. So what we're seeing largely from HDFC Bank is large positive coming on the asset quality side of things. Profit after tax therefore was largely in line with what the street was penciling in. What even brokerages continue to suggest is that they are quite positive or quite bullish with regard to the stable set which HDFC has delivered, especially on the asset quality side. We continue to expect OPEX to remain elevated, and let's quickly take a look at a couple of those notes. What Kotak continues to expect is they've hiked their target price to 1925 a share from the current previous 1800 rupees a share. Lower provisions is what they believe will continue to drive growth. Investment in the business remains high is what they observe, and they believe that the recent or the upcoming merger will continue to remain a near-term headwind for the bank. CLSA has an interesting take. What they believe is that the risk reward now is evenly placed with regard to valuations. So they believe that the multiples are now fair, and HDFC Bank can now be an earnings compounder going forward. What they also believe is that credit costs will continue to provide an offset to the higher OPEX even in FY24. So that's an important observation coming through. Also on Investec, they continue to maintain a hold. They've hiked their target price to 1720 from 1690, and they believe that the merger related concerns continue to remain unaddressed. So of course, as that merger unwinds, we'll have to see more on HDFC Bank.
I want to go back to SGX and let's look at what is happening in SGX. And by the way, Bitcoin, that surge continues. The unabated surge in Bitcoin continues as if Bitcoin is the new gold of this year. Bitcoin in this year, Kunal, is up 80%. Yeah. You never told our viewers to buy Bitcoin. You missed it.
We never discussed.
Yeah, but you should have flagged off. Why Sona? Everybody said gold.
Not everybody.
Everybody said gold. Nobody said Bitcoin.
Not everybody said gold in November 2022. Nikunj.
No, but I'm just on the lighter side. I mean, the comeback in Bitcoin is nobody anticipated.
Yeah. It's very so. I think I just tweeted some time back that it's more of a risk-on phase which the markets are going through right now, because Bitcoin, gold, equities, emerging markets, developed market equities like for example CAC hit a lifetime high. So I think it's a phase of the markets where the risk-on is coming back, and that's where you see a lot of these high beta assets making a comeback. So I think it's just a phase of the markets.
It's SGX for you, down 99 points. Now this week in a sense, yeah, you may just get challenged, but then later on this week you got the big number, Reliance. And considering that right now, Reliance has just got its mojo back, and Reliance single-handedly has led the market rally in terms of the recovery. Reliance numbers are important. A, we'll get a timeline on the NCLT demerger of Reliance Financial Services, which means those free shares are coming. Something will be indicated on that. B, Reliance numbers are coming at a time when markets are searching for leadership. Apart from banks, what is going to be that other angle? The Indian market, in a sense, can be divided into 4 parts. You got financials, 30%, 35%. You got IT. You got large, old economy boys, which includes a Reliance and ITC, and then you got consumers. Within this square of 4, IT remains weak. But can the 3 other ends make up for the loss ground? L&T is at an all-time high. Reliance has got its mojo back. So while Infosys is going to be crushed today, will there be enough and more strength coming from Reliance and L&T? Rudramurthy, good morning. What is your sense? Will Reliance and L&T do the needful what Infosys will lose?
Nikunj, good morning. For me, definitely L&T looks much stronger compared to the other IT pack, or even for that matter, Reliance with results awaited. For me, big bet is on Larsen and Toubro. If I just check the chart patterns of L&T, definitely it has just broken out now from a consolidation pattern. The levels are at around 2230, and last 2-3 days we have just seen that small amount of profit booking on a very shorter time frame, and stock is definitely headed for further up move. So I will be a buyer in L&T at current market price, or any dips to 2230. Look at initial targets of 2350 and then 2500 on L&T. Reliance even definitely looks strong, but it has been much a big move in a very short term, and having taken that strong supports at around 2180 to 2200, it has just moved up 150 rupees, and then it has consolidated again. It is giving that patterns of breakout. So if Reliance stays above these current levels of at around 2350 2340 zone, yes, Reliance can further make that up move. I can see Reliance moving towards levels of 2420 first, and then eventually to levels closer to the 2500. So L&T Reliance definitely looks good. I feel IT might further correct for a very short term, keeping in mind the Infi bad result, and then we can get that cushion from stock specific counters like Reliance, L&T, and even few select banks can just give that push up in market, and then it can balance out the fall in IT.
So let's talk stocks then. Rudra, what is on your recommendation list?
See, I'm going one sell call and one buy call. Bandhan Bank looks very weak to me. If you see, even on day like last week, Thursday, Friday, when markets was giving a big pullback, banks were just flying, you could see Bandhan Bank was definitely very weak. So for me, Bandhan has broken all crucial supports. Now it is headed towards levels of 190, and even eventually this stock can come to levels closer to 170. So for me, Bandhan is a sell with a stop loss of 215. Keep a stop loss of this and then a target of 190 initially. For me, granules looks very strong. Pharma can be a pack which will perform on the upside, and I have just picked up granules, even though all other stocks like Sun Pharma looks very strong. Even for me, Laurus Lab looks very strong. I have just opted for granule. 295 can be the stop loss, and look at initial targets of 330 on granule. So a buy call on granule and a sell call on Bandhan Bank.
All right, there you have Laurus Labs, Granules India, Bandhan Bank. Those are some of the recommendations from Rudra. But time to put the spotlight right back on HDFC Bank, and Kajal Gandhi is joining in to assess the numbers for us. Kajal, what's your sense in terms of the rise in OPEX for HDFC Bank, in terms of their strategy for this kind of growth, and how would you look at the overall numbers, the fact that asset quality as well has improved, and this time around you've also seen the CASA growth as well that has been decent?
Hi, good morning. Yes, HDFC Bank as such has reported a good set of numbers. We have seen a continuous improvement even in NII growth this quarter also. And bottom line also, on the PAT front, they continue to report this 19.7% PAT growth. But when we look at overall OPEX, I think that's one area which they have highlighted, continuing to be spending a lot on that, and for the branch and the deposit network, which I think from a budget perspective is what they are looking forward for, making their deposit base on the higher side. So opening of a huge branch in this quarter itself was a unexpected thing that happened. But still that, I think considering the overall merger scenario, this looks a good strategy, and with the base shoring up of this deposit base, they should be able to manage that liability thing well.
Okay, there you have it. That's the view coming in. What's the outlook then when it comes to the overall asset quality front? You know, we did speak about how there has been an improvement this time around, but is there some sort of a risk build up in your view, and how do you expect it to play out?
I think per se they are doing, HDFC Limited is already selling whatever I think they were having the pain assets, or they may be wanting to get rid before they get into the merger. And HDFC Bank, I think sequentially has shown improvement on asset quality with this GNP ratio. We believe that asset quality from the retail book perspective is still not a big concern for HDFC Bank or the sector as a whole. Somewhat MSME or the Mudra loans in the recent past, which had been done, may create a bit of some increase in NPA numbers. But from the size of the bank, HDFC Bank or the sector as a whole, these loans, I think NPA should not be so large in numbers, and which should not impact overall bank HDFC Bank in terms of earnings or on the provisions numbers. They are sitting with such 170, 180% of excess on the provision side and huge floating plus other contingent provisions. We don't believe asset quality in the coming period is an issue.
Right. Kajal, just very quickly then, there are upgrades galore on HDFC Bank and many continue to believe in the compounder that traditionally HDFC Bank has been. What are you upgrading your target to?
So we already have a buy rating on the call on the stock, and we are having a target of 1970 on the bank. So we will remain positive. In post merger, also constructively, we should remain positive.
All right, there you have it. That's the view coming in on HDFC Bank. But let's connect with Sandeep Agarwal then, independent market expert, to talk about Infosys numbers. And a disappointing set is the only way to really describe it this time around. What's your outlook on how the street is really likely to assess, in particular, the fact that there's been a cut in the revenue guidance?
No, I think you are absolutely right. There is a big disappointment on all fronts, both margin growth and also guidance. And, this kind of, indicates that there will be a expected contagion in the
That line with Sandeep Agarwal. We'll take that up later. Just looking at the market construct, and Kunal, let's delve deeper into this entire TCS versus Infosys, and then of course the mid-cap IT debate. Because while Infosys has actually managed to outperform TCS for the last, I think, 4 years in terms of purely their growth projections, that's going to really change now. And this divergence in the valuation is only going to increase the gap, that is. How are you monitoring TCS versus Infi on the charts? And then what happens to the mid-cap IT names, which the street was relatively bullish on? Some of them sitting at a 52-week high, for instance.
Yeah, I was listening to the point which you were making that Infosys had actually outperformed TCS for a substantial amount of time. And the charts were also very, very similar, that Infosys managed to outperform TCS by a huge margin. Now, even if we take or start comparing from 2020 lows, where Infosys outperformed significantly, I think it multiplied 2x or 2.5 as compared to TCS, which I think had recovered just about 2x or less than that from the 2020 lows. So Infosys outperformed in that period, and even on the downside, I think Infosys corrected a bit more or less as compared to TCS. But the approach for the two stocks have changed quite dramatically in the last 3-4 months. For example, Infosys had started to underperform. It was one of the first large cap IT name which managed to make a new swing low for itself as compared to TCS, which managed to withstand the 3,000 mark. The interesting bit is on Friday, just about last week, the open interest jump for Infosys was around 8.5%. This is one of the highest jump the stock has seen in the last 4 or 5 days, which and the stock was down some 2.5% on Friday itself. That means market traders went into the Infosys result on a short or a bearish note. So for most of the traders, it doesn't come as a surprise that Infosys result has disappointed, and possibly the stock may open with a severe gap down.
Yeah, I mean, given that the ADR itself is in 11%. But Sandeep Agarwal is back with us. Sandeep, if you can hear us clearly, you were making your point in as to how Infi has been such a howler.
No, so there is a disappointment on all fronts. There is no doubt about it. But and also it somehow indicates that there is a bigger contagion from US banks which can happen in the industry, and that is what these managements are now very careful and cautious about. And that is the reason this kind of guidance and this kind of outlook they are sharing, despite a strong order book, whether it is from TCS or whether it is from Infosys. Only point I would like to highlight that, in case of Infosys, we have always observed that, their alarm bells for any kind of caution or warnings are little more higher or have more decibels. So, not necessary. You can assume that what they are guiding is probably the bottom of what you can expect in actual. We have seen that multiple times in the past. So I will just give that disclaimer that this would be probably their guidance should be taken as the worst case scenario. That is all I would like to say.
All right. Thanks very much, Sandeep. We also have Trip Chaudhary with us to understand the numbers in greater detail. And Trip, what we were discussing earlier is do you think that this time around, while it has been this huge disappointment in Infosys, we are likely to see, maybe a couple of quarters of this ripple effect play out and then things will gradually improve? Or is this a sign of, much worse times to come for Infosys?
I think as we have been speaking before and told you, like the macro conditions are horrible. The IT budgets have been slashed between 20 and 25%. And if you think about how the industry evolves when it goes into a recession and when there's a recovery, the world before and after are always different. The question to ask is, are all our IT services in India equipped with the DNA to reinvent themselves in a post-recession world? TCS has always shown they have the capability. Infosys has shown its capability of reinventing themselves, but that is associated with a change of executive and management team. If you can see every recession, before and after, there's a shift of CEOs. So I think the downturn is going to last for at least 2 years. I think 2025 is when we can see the recovery. I think there's more pain ahead for at least another couple of quarters. Then it will be bouncing down the bottom. Recovery in 2025.
But Trip, is this the fallout of the meltdown that you're seeing in US banks, or is there more than what meets the eye?
I think we have to think in terms of financial policies of Janet Yellen and their cohorts. When you are raising the interest rate, it kills all industries. They should have done surgical tightening. That is, they should have sold, we can go into details, but these mortgage-backed securities should be sold. So that would have brought the red-hot real estate market down, but not destroy the whole industry. The problem is Silicon Valley is literally in recession. It has been recession for almost 2 quarters. And I don't see any signs of recovery. And unless the layoffs stop, I don't see any sign of recovery. If your number of employees continue to decline, that means your IT resources are going to be less used. And all the subscription-based models are going to hurt. So I think you should bring them down. Every person should bring them down between 20 and 25% and see what is the right valuation for all the Indian IT services companies. I don't think investors should be in hope and pray that a miracle will happen. The problem is damage has been done. Interest rates are too high, and that causes problems across every sector.
Yeah, that it sure does. And trust me, the estimate cuts are really as deep. But Trip, great to have you on the show. Thanks as always for staying up and taking up a call. Let's take a very quick break. When we come back, chat markets and sectors with Sandeep Sabharwal.
All right, Sandeep Sabharwal also joined us. Now I'm going to take the conversation forward. Sandeep, this is the first time the management of IT companies have come out and they've admitted there is a problem. We've spoken about this with you about a year ago, and markets had started punishing these stocks 6-8 months ago. Are we at that turn where you buy the bad news from the management, or we are in for a long winter?
See, Nikunj, I don't think the winter will be long, but I think it will last for some more. So that's what people need to recognize, that it's a at least 1 or 2 quarter kind of phenomena, because IT spending, especially the discretionary side, has a lot of it too has to also do with sentiments. All of us think that companies and the managements take logical decisions, but many of their decisions are also run by their perception of what's going to happen. Now that perception is becoming more negative than what might actually play out, and to that extent, the managements of these IT companies are recognizing it now, which I was saying for a long time that they need to first recognize, and that's when the stocks will move to levels which can become buy levels. So I think that's where we are. There could be more cut in earnings going forward after the first quarter, but I think that will be it. So it becomes key when you want to buy these stocks. So let's say Infosys from the 1400 odd level falls 15-20%, then irrespective of whatever the news flow is, you buy, because it's built in the worst negative news. So I think that's how we have to play these large IT stocks, because you cannot be permanently negative on these companies because of the fact that they have no debt, they are huge cash generating businesses, and they do frequent buybacks and pay out large dividends. So, but right now the scenario is negative, and from whatever these managements are talking, things could become a bit more worse.
Let's understand that in terms of a level. Brokerages have come out with knives and they're slashing the price targets down. A year ago, nobody had a downgrade on IT. Today, everybody has a downgrade on IT. Is it too late to sell now? You may not buy. You may say, okay, 5%, 10% the stock may fall. But when the turn will happen, Sandeep, the turn is going to be equally sharp.
Yes, for Infosys, I'll say that if it opens 10% lower as the ADR indicated, long-term investors I don't think should sell. Because from that 10% down, maybe there could be another 10% down, but I don't see it falling more beyond that. So for people who want to buy, they should wait out. There are many other sectors which are giving better opportunities at this stage. For those who are holding and were reluctant to sell right from 1900, whatever top it reached, till 1200, it makes no sense for them to sell at 1200.
Of you coming in on how we should really be reading into those quarterly numbers from Infi. Let's move right on though and talk about the record year for pre-sales when it comes to Kholte Patil. We have Rahul Talele, who is the Group Chief Executive Officer, joining in on the show. Thank you so much for taking time out. Pretty strong in terms of the record year that you had guided for. What is demand looking like on ground? And the question is this momentum, according to you, here to stay? For FY24, what would be your guidance?
So first of all, let me share. See, we have computed the highest ever pre-sales number for the company, highest ever collection numbers for the company, as well as our delivery. The OCs are very strong. Simultaneously, if you see, although we have launched most of our inventory in H2, we could sell around 60% of that launch inventory. That itself shows there is a strong momentum in the industry, particularly in a residential real estate industry. And considering that, we are planning to launch multiple projects in near future. In Q1, we are planning to launch 2 to 3 million square feet of more inventory, and certainly we are confident that we'll achieve a similar kind of launch success in these projects as well. So in last 2 years, we have almost doubled our pre-sales number. So 45% and then 30%. Certainly, we won't be happy with lesser number for the FY24.
Where is the growth coming from? I mean, are you saying that there is no slowdown whatsoever?
No. In fact, as compared to Q3, there is a positivity in the Q4, considering the fact that the interest rates are now stabilizing. There is an accumulated savings. Customers wants to give as a down payment. That is a positive thing. Spacious units are moving. So spacious units are not the first buy of the customer, and accordingly we could see one project we launched in the month of December. In the 45 days, we sold out that entire inventory of more than 200 crores, spacious units of 2 crore plus at our flagship project, Life Republic. So there is a very positive demand for the spacious upmarket product, and we are confident that this is just an uptick of residential cycle and it will continue, barring the 1 or 2 quarter setbacks. But on a long-term basis, 3 to 5 years, certainly there is a very good demand. That is what we are looking for. And considering our strong launch pipeline, we are confident of delivering on this projected guidelines.
Really appreciate your time. Thank you for joining us. Sandeep, DLF, record sales in the sub-luxury or the luxury market a month ago. We've got record growth coming from Colte Patil. If I speak to Prestige, they're also using the word record booking and record guidance. Where is the growth coming from, Sandeep? I mean, we are talking about slowdown, we are talking about job losses, we are talking about impact of higher interest rates, but real estate companies are just getting it right.
Yeah, because so it's a intriguing K-shaped economy where luxury cars, four-wheelers are getting sold more, two-wheelers are not getting sold, consumer durables are suffering, but luxury brand sales in India are moving to all-time highs. And it's also, these luxury sales phenomena is also a global phenomena. So I think that's a feature of the K-shaped kind of economy. Now, real estate is a tough investment because a lot of the pre-sales there need to get converted into cash flows and actual deliveries, etc. And a lot of times we've seen in the past that that doesn't really play out as per script. But since you have specifically asked about DLF, I think they are pretty well placed, and that's a company which has been very conservative over the last few years, manage the balance sheet, etc. And many of the new projects, like you said, and like the management of the company we're talking of, are getting sold out very fast. So I would think that there is opportunity in few stocks, and on top of that, heap could be DLF.
Right. Sandeep, what do you do with HDFC Bank right now? Was just looking at the last 1 year performance. The stock is already at a 52-week high. I think it gained about 7 to 9% in just the last 1 month or so. What happens next? Considering the street expectations were a little elevated, and on this kind of a broad base, HDFC Bank has managed to meet the estimates now.
So there were no negatives in the results. So I think people are looking for negatives. There were no negatives. Credit growth figures had come out earlier. They could deliver strongly on the net interest, and like all parameters are good. The only issue now remains is what happens post merger with HDFC, when they'll have to raise significant additional deposits, and CASA deposits you can't grow like that. They are steady growth phenomena which comes through long-term customer acquisition. So most of it will be through fixed deposits at higher rates that will hit their net interest margins in the short run, and plus the entire HDFC book will have to follow SLR, CRR, etc. requirements. So I think it depends on if they get some relaxation on some aspects, etc. So we need to see, because still there is no news about any relaxation from RBI.
Okay, fair enough. We've also got Shivangi Sarda who's joining in on the technicals. Shivangi, let's get in your take then as to what the charts look like when it comes to some of the heavyweights. For instance, you've had L&T, which has had a pretty steady run up so far at 22.58. What is it that you're advising, and what's the outlook as well when it comes to some of those pharma names like a Sun Pharma, Divi's or Dr. Reddy's that were under pressure on Thursday's trading session?
Absolutely. Thank you for having me. So we've seen that, heavyweights L&T, there has been some profit booking decline, at higher zones. But then again, if you look at the weekly structure, it is quite positive, and it, gave a slightly lower closing, but then it respected its previous week's low as well. So overall, the structure is quite positive, and we would, recommend that any declines could be used as a buying opportunity. And one could look out for levels of around 23.50 over here on the upside, and a support near 22.20 levels.
Sandeep, I think L&T is your largest holding. You've got that one right. What's the way forward for L&T now? At what level you think you'd like to book out?
Booking out of L&T might not make sense for some time, but I think reduction in exposure might be a right thing if it rallies another 10-15%. So I would say that if it goes up to maybe 2550, 2600 level, then I would like to cut back a bit and maybe look at opportunities at beaten down technology stocks at that stage. But right now, I don't see a sell opportunity because the order flows they've been reporting have been very significant across sectors, and their defense foray is also becoming stronger and stronger.
Kunal, L&T, can it be 2500 soon?
Yeah, I think after a bit of a pause, yes, the stock is, so, it has this tendency of migrating 150 points, 200 points, then staying stagnant for at least a month or and a half or more, and then moving up higher. Most of the other peers, like I think ABB, etc., these stocks have seen a correction, for themselves in the I think 1 week or 7, 8 trading sessions. So, which means that it's bound to be that L&T would either go into a bit of a profit booking mode, or if not, then at least a time-wise consolidation. So, I think at current levels, 2000, 250, 300 approximately for L&T, it's a good zone where we may expect mild bit of profit booking. So, assuming if it comes back towards the lower end of this trading range, say 2200 or 2180 levels, that would be actually a good zone to go back and look out for more longs on L&T. So I would play for more range over the next couple of weeks rather than any kind of a direction for the stock.
Sandeep, outside of L&T, where within the entire manufacturing theme, which is a very large umbrella, do you still find comfort to maybe add to the current positions or buy afresh altogether?
See, most of the companies are doing well on the manufacturing side, so we need to watch out for the results as they come out for this quarter. But overall, companies catering to railways, even the transmission tower companies, or companies catering to construction infrastructure on a EPC side. So, so I prefer EPC companies which are uh, taking orders from state or central governments or large private companies rather than going in for BOT HAM projects, which have led into problems in the past, and I think similar problems will come in the future. So among the stocks we are holding are NCC. We've been holding for some time. We are holding Ahluwalia contracts, which has won significant orders in the recent past and looks set for good growth. Then we have VATech Webag, which also is in a similar position of growth. And then the other companies like Thermax, etc., which are also doing well, but recently they have sounded some caution, so we'll have to see how the results come out.
Interesting. Shivangi, stack up the charts for us. NCC, Ahluwalia contracts, the stocks that Sandeep just highlighted, and VATech Wabag.
So talking about NCC, we've seen that this stock has been moving in a very consolidative range for the last 2 weeks, and it did try to come out of its zones of 108 levels, but then we've seen that it has been hovering around in a very narrow range. So this stock is expected to be in a positive to range bound manner. The momentum is not really seen over here because of the low volumes that it ended in the previous session.
NCC 107. 6 months ago, NCC, Ahluwalia, frankly, these are not the businesses which were really the talk of the town. Sandeep, why construction stocks? I mean, these are low margin businesses, extremely cyclical, highly dependent on what happens at the state level or at the private level. There are elections around the corner. Elections can change the equation of some of these promoters with the government. I mean, if there is a change of guard, why should one buy these stocks?
So I think that's where we are careful what we are buying. So one is that you need a diversified book where the orders are spread across various states, central, state government, private sector orders. Secondly, focus on companies which have focused on controlling their debt. For example, a company like Ahluwalia has no net debt on their books, effectively no net debt. NCC has cut down debt significantly even when they have been growing. VATech Webag is zero debt. So focus on companies which are controlling their debt and growing, and taking orders which are largely centrally funded or from large corporates or from multilateral organizations. So I think once you identify those, then the growth opportunity over the next 2-3 years is very significant. Their valuations are much, much lower than the entire mid-cap basket as well as the market still after the kind of up move they have seen in the recent past. and they are very, very under-owned. So I think there are various reasons one should buy, and we'll see how it plays out over the next couple of years.
All right, let's move right on. Lots of other fresh brokerage notes that have come out this morning, and the likes of Equirus, Investec, they've initiated positions on stocks like APL Apollo Tubes, Mrs. Bector Foods, and even Delivery. Let's take it across to Vamakshi, who joins in with a quick snapshot of all these brokerage notes. Vamakshi?
Well, absolutely. A lot of counters will be in focus after Investec and Equirus have initiated coverage on these counters. Let's first start off with APL Apollo Tubes. We have a note that has come in from Equirus, and they're highlighting that this company is a very strong structural play in an expanding market. The company is also well placed to capitalize on the industry growth levels, as well as the rapid shift that is happening towards the value-added products could aid the company's profitability going ahead, and that could be on an uptrend ahead. So given all those factors, Equirus has initiated coverage on this counter with a long rating and given a target price of 1,413 per share. Delivery is the next counter on our radar, and Investec believes that the company has compelling competitive strengths. The business is heading towards profitability, and in fact they're expecting the company to turn EBITDA positive in FY24. They like the company's business model as well as the industry structure, and that is the reason why they have initiated coverage on Delivery with a buy rating, target price of 415 per share. Bector's Food is the next one on our radar, with Equirus saying that their biscuits business is growing on the back of distribution-led initiatives as well as premiumization. The bakery business is also growing from strength to strength, and in fact they're expecting margin expansion to come in for this counter as well. So given all those factors, Equirus has initiated coverage on Bector's Food with a long rating, target price of 705 per share. Lastly, 361 WAM will be in focus. Investec believes that the company has some very strong growth levers in place. They're expecting consistent compounding coming from this counter. In fact, they believe that the model that the company has mitigates some of the key risks. They're expecting AUM and PAT to grow at a CAGR of nearly 20% over FY23 to 26, and revenue to grow at a CAGR of 17% over the same period. So given all these positive factors, Investec has initiated coverage on 361 WAM with a buy rating, target price of 675 per share. So largely on the back of all these initiating notes, you should watch out for all these counters.
Okay, lots of stocks which are going to be on our radar. Of course, the key sector to look out for is going to be IT, and a bit of a tug of war between HDFC Bank and Infosys today. I think HDFC Bank has, Nikunj, what, over a 30% weightage?
No. Then I think highest would be Reliance.
Highest is Reliance. Then I think TCS.
Then it would be HDFC Bank, and then I think it would be Infosys. It may have changed. Financials per se have 35% weightage. So you have to put everything together. That includes SBI, HDFC Bank, ICICI Bank. You have to put all the financials together. It varies depending on the time frame and varies depending on the curve which you're looking at. 30 to 35% weightage is what they have. I have historically seen that when a sector weightage has reached beyond 35% on the Nifty, the sector tends to underperform. The same thing happened to financials in 2019. The weightage had gone up to about...
So are you saying financials are going to underperform or IT?
IT weightage is not that large. Historically, when the TMT weightage had gone to 35-40%, it underperformed for years. Reliance weightage in peak of 2020, when the Jio deal and other blockbuster deals happened, it actually went to 14-15%. So if an individual stock reaches 13-14% weightage, it tends to underperform. And the two classic examples here are number one, Reliance. In 2020, the weightage went to 13-14%. 2 years Reliance underperformed, and before that it was HDFC Bank which went to 12-13%. It underperformed. Actually, it will be historically good idea to look at how the weightages actually have changed. Sandeep, are we reaching that point in HDFC Bank that 12-13% weightage it will start underperforming?
It's possible, but I think not because of the weightage per se, but because of the entire merger and the kind of margin pressures, etc. it will built in, because of the fact that we already talked of the fact that they'll need to raise deposits at higher rates, undertake CRR, SLR related setting aside of money, etc. So I think those are the uncertainties which still remain related to the merger, and the stocks had a good run this year till now. So I think now there is some news flow that because of this merger, huge headway gets created, because of which foreign funds will have to buy because of the foreign indices. So I think those are technical factors which might be supportive in the near term. But Longer term, we'll need to see how the entire merger plays out, and to that extent, building in a case that stock can rally hugely from here in the short run might not be the right one.
Ayesha Motors also in the spotlight. It's on the brokerage radar this morning. Kotak has maintained a sell rating on the stock with the target price at 2,800, saying that the demand recovery domestically for the RE portfolio remains uninspiring. Competitive intensity as well is set to increase over the coming years, and that the demand trend as well looks rather weak all in all for the RE portfolio. Would you agree with this assessment, Sandeep? What's your take when it comes to Ayesha?
So Aisha, after the huge outperformance over the last 1 year, is in a zone where one would say that it's neither a sell nor a buy. So I would think that I would be slightly somewhat neutral at this stage. Look at how the numbers play out over the next couple of months. Well, the numbers have not been bad actually. They've been doing reasonably well. Export markets also have been doing well for them. So to that extent, there is nothing to be very negative. But after the run-up and huge outperformance over the rest of the auto space, the near-term upside also is limited.
Okay, the pre-open rates, let's see what the rates for Infosys, for HDFC Bank and the Nifty are up to. I think we'll skip those rates and give them some time to adjust because they're really all over the place. Let's start off with HDFC Bank and then Infosys. Infosys 10% lower, in line with what the ADR was indicating, and HDFC Bank gaps up 5%. So, Kunal, you were just talking about their weightages. HDFC Bank is 11%, you said?
Yeah,
9.5%.
9.5%.
9.5%, right? And Infi was?
Infi was
6.7%. So, will be quite the tug of war today between
No,
these two.
look, I mean, Infosys will go down 10%. HDFC Bank
It
will
has
not go up
already in the
10%.
pre-open.
So it will now go. You would ask yourself that. So let's keep HDFC Bank aside. I don't think these numbers were bad, but these numbers were not bravo that it's going to go up 10%. You know, whatever everyone may say, my limited point is that what the number which matters to me is the CASA growth. I think the CASA growth is decent. Second is the crystal clarity on the timeline in terms of where the merger is going to move. There is more and more reason to believe that between mid-June to mid-July, the merger will sail through. That changes the equation for an institutional investor. With Infosys, what you got to ask yourself is that, okay, 10% decline, what do you do after that? Is the reason for you to get panicked and then sell Infosys? Or 10% decline, another 5%, and then Infosys actually should be part of everyone's long-term portfolio. That is something which I think is worth considering if you are really invested in Infosys. Is it too late to sell and is it too early to buy? I think that's the app line, that it's too late to sell and too early to buy. But the stock we've not discussed is actually AU Financials. Yeah. That was the real darling.
Big mover from
real darling.
Thursday.
Yeah, Thursday. 17-18% is what AU Financials added. Yeah. Shivangi, do you track this one? I mean, at Motilal Oswal, I know that there is this long-term association with AU Financials. So technically, I'm sure you must be tracking it.
Absolutely, we've been tracking this stock, in fact, and we've seen a great price volume surge over here as well. And the way the price has been holding on, it's quite remarkable. This entire space is quite positive. In fact, the banking sector is getting quite a lot of tailwind from the heavyweights as well. In fact, AU Bank has already rallied, and so I'm liking ICICI Bank in this space. Which has, I'm taking this opportunity to talk about it. So, this stock has, been continuously making higher highs, higher lows, and, on daily frame. And it is coming out of its, range on weekly frame as well. This stock is quite positive with good amount of volume and open interest addition over here. So, I would recommend that ICICI could be a good buy over here at these levels with a target of near 935 and a stop near 880 levels.
What those mid-cap calls are, by the way, after many weeks of truncated trading, I think we finally have 5 clear days of trading. So we'll get a little bit of a clear idea as to what the market direction is. And as we said, of course, it's critical with all those numbers. But mid-cap strategies then. And Kunal, what's popping up on your list?
So it's Bosch, which has managed to make a comeback again. The stock, which did exceptionally well in the last 2-3 weeks, went into a correction. I think 1,000-point plus correction the stock had seen in the last 3 or 4 days. On Friday, we saw a mild comeback, so that could probably be an indication that this 1,000-point correction could be over, and the stock may be ready for breakout of the previous swing high. Buy with a target of 19,750 and stop loss to be kept at 18,500.
All right, Shivangi, let's get your mid-cap call.
So from the mid-cap space, I'm liking JBM Auto. We've seen that this stock has been moving quite in the positive territory from the last 2 weeks, and there has been good buying interest from the month of October. So from the last 6 to 7 months, the stock has been continuously making trending upwards, making higher highs, which means that the base is gradually shifting higher. Now it's near its all-time high levels, and it is ready to move in a new price territory. So recommending a buy here with a target of 790 levels and a stop near 740 zones.
We have in the pre-open session, hello, Infosys down 10%. In the pre-open session, HDFC Bank is up 3%. And Nifty, I think this will get settled. It's not going to be 113 points higher for Nifty. Remember, Indian markets were shut on Friday, SGX was also trading. But net, I don't think you will be in for a 150 kind of an upswing. All right, what are the other IT stocks? Let's look at all of them. HCL Tech flat, Wipro flat, TCS is down by 1%, LTI persistent down 2%. I think where the operative word, Ayesha, would really be that is this problem now centered around BFSI. So look at companies which have all Indian IT companies have a large exposure to BFSI with the exception of Tech Mahindra. So I think Tech Mahindra in today's market becomes a go-to stock. It really becomes a go-to stock. Are these real rates? Infosys is up and TCS is down 10. Infosys?
No. There's a lot of volatility, and Kunal perhaps would tell you better.
Yeah,
the rates are just all over the place.
Yeah, but 2 minutes up, down, roller coaster.
Yeah, it could happen. Pre-open rates.
These are random rates. So let's not look at these random rates. Infosys is down 10%. Rest of the IT stocks have just not gone to the cleanest, so to speak. Now, this is the maturity of the market, or markets are telling you that, folks, there is a problem with IT, but the problem in Infosys is much bigger than what the IT sector seems to be, experiencing. I will not be surprised that in today's decline, Tech Mahindra will be the first one to bottom out. The logic being that Tech Mahindra gets least amount of business from the BFSI space. They get a large amount of business from telecom and other verticals. The problem is the BFSI space. If problem is the BFSI space, then the company which is not in the BFSI space is not going to be feeling the heat. It's like in the last decline of telecom, Tech Mahindra felt the heat because they had a problem with the AT&T account. That really could be the factor at play, because for Tech Mahindra, valuations are cheap, change of guard. Infosys has lost their BFSI star. Yes, how could we forget that? Mohit's now gone to Tech Mahindra. So I will not be surprised if a stock like Tech Mahindra, for that matter, even LTT, some of these stocks actually start bottoming out in today's decline. Would you agree with my assessment, Mr. Bothra?
Yeah.
Tech Mahindra, strongest chart.
Yeah, it seems like. Because in fact, in the last 3-4 months, it was Tech Mahindra which has been extremely resilient. Wipro, Infosys, TCS. I'm not sure of HCL Tech because I have not tracked the chart, frankly, for the last couple of weeks. But I think these three stocks have underperformed significantly. Tech Mahindra remained at this 1100 mark, tried to digest major part of the volatility. So, assuming if the stock corrects by another 2 or 3%, as shown by the pre-open rate, I think that could be a good zone to buy Tech Mahindra rather than betting on the traditional large cap names.
How's Reliance up?
Okay, that's on IT. Let's see what Reliance as well is up to. Remember, the numbers are slated for Friday, post-market hours, although a little early perhaps to see what Reliance is doing, but that's 3% higher. Let's just skip these pre-open rates. We'll talk about it when the market opens.
Index calls then. Let's find out what exactly our chartists are advocating. By the way, on the pre-open rates, for now it's 17,862. Buy, says Kunal. According to Rudra, it's a sell recommendation on the Nifty and a hold call. So divergent views really coming in on the Nifty Bank index, on the Nifty index, this morning. What about the banks? It's going to be quite critical with HDFC Bank having come out with its numbers. You've got Kunal saying book profits, but it seems to be a consensus when it comes to the rest of our chartists who say hold on the Nifty Bank index.
In the pre-open session, TCS is down 1%, HCL Tech is down 2%. These are the real rates where you expect the market to open. And it is not like, oh my God, Infosys bad numbers and Nifty is going to go down the barrel. If at all, because of the weightage of HDFC Bank and Reliance, we may actually be in for a decent start. Watch out for companies which have a high exposure to BFSI. For me, that becomes the problem area now. And 2% down for TCS, 4% down for Tech Mahindra. Let's see where the entire space settles. I think it's too late to sell Infosys. That's my view. It's too late to sell Infosys. Shivangi, the charts of Infosys today would be damaged. And if it is a 10% gap down start, the damage is going to be a large damage. Would you initiate a short after a gap down 10% start?
So see, Nikunj, what we've noticed in the IT pack has been, that even when the stock with the entire, sector tried to show a little bit of strength, it could not hold at those levels. And with the gap down today, I feel that, the stock could see a little more damage there is a level of 1200 levels that we could expect in this stock. With a stop near 1275. So, watch out for these levels after the gap down, and we could trade accordingly.
Let's also discuss some of the other stocks which are going to be in focus. I know we're obsessing about what IT and HDFC Bank are going to do. But remember, Tata Motors is also going to be increasing their passenger vehicle prices from May 1st. So look out for what that stock is well done. Adani Green has come out with their operational capacity, which has actually seen an increase of about 49% on a year-on-year basis, about 8,000 plus megawatt. That stock has gapped up about 2.5% as we speak right now. There's also Z. Remember, Oppenheimer is going to be selling that 5.6% stake in the company via block deals. That's what most reports seem to be indicating. So look out for Z as well. Our expert Sandeep Sabharwal was just talking about VA Tech Vibhag, and they're looking to sell about 100% stake in one of their Switzerland arms at about almost 4.8 million francs. So look out for that as well in trade. There's also Zydus Life. They've got a US FDA approval for one of their key injections. So that as well is going to be in focus. HCL Technologies as well, considering Anand Birje has resigned as the digital business head of the company with effect from May 5th. So pretty much immediately, that stock as well is going to be in focus.
It's all about IT. Let's see if the collateral damage in Infosys and the upside we will get in, let's say, in HDFC Bank, will it neutralize each other? Two wheels moving in the same different directions, will the net impact be neutral for the market per se? Let me tell you that SGX and the pre-open rates are indicating that we could be in for a green start. A rub of green is something what markets want, but I'm afraid it is not a rub of green. It's a gap down start with a positive breath. It's a 5% down for the IT index, and that's largely because of the weightage adjustment. TCS and Infosys, if they both are on the same side of the trade, IT goes down. I mean, it's a simple point to bring up. Bank index or the bank Nifty will be off to a great start. Why? Well, that's because of, thank you, HDFC Bank. Reliance is off to a good start, but Infosys is where the collateral damage, I think, is visible. 10% down for Infosys. You don't see a stock like Infosys fall 10%. And this is a stock where I think the selling is not done yet. Numbers have been poor, pathetic, horrible, and they will force everybody to derate the stock. The street is derating large cap IT, and it is derating large cap IT quite vehemently. You got a 3% decline for TCS, you got a 10% decline now for Infosys. Meanwhile, HDFC Bank, Kotak Mahindra Bank and Reliance are looking strong. I want to look at AU Financials. That was the star on Thursday, hit out of the park. Sanjay Agrawal's extension from expected 2 years has become 3 years, but that also is consolidating. Power Grid, Dr. Reddy, Ayesha, nothing meaty in the market per se. It is adjustment of numbers which I think is very visible. I would say watch out for Tech Mahindra. The BSFI exposure is low. If the problem is with the BFSI space, then companies which have a limited exposure to BFSI, they will start limping back to normalcy. Companies which have high exposure to BFSI, Mindtree, LTTS, some of those companies in a sense will be in a spot of bother. And HDFC Bank also, by the way, is not reacting to numbers. It's down 1%.
It's actually fallen. So HDFC Bank as well is now down about almost 1% after a bit of a positive start. There's a block deal in Z, so I think that Oppenheimer deal has happened. There were reports indicating that they're looking at selling that 5.6% stake. So just look out for that counter as well. I don't know if we can bring up the volumes that we're clocking right now in Infosys, because this selling, remember, is also coming on the back of huge volumes. Kunal was just highlighting earlier as to how the pre-positioning ahead of the numbers. Remember on Thursday itself, you had Infy down about almost 2%. So the selling is coming on the back of bigger volumes as well. And not just Infosys, it's pretty much across the board. The Nifty IT index alone is down 6% as we speak right now. I don't recall the last time the index alone, or rather index itself, was down 6.5%. There you go. That's where the Nifty IT index is. Pretty much all the composites of the Nifty IT index are bleeding right now as we speak. TechM, LTIM, Persistent, Forge, they're all the top laggards today. On the flip side though, Power Grid, SBI Card, Ayesha Motors, Kotak Bank, DRL. But I must point out that, the IT weakness aside, there's no relative strength either in the market. Your biggest gainer is Ayesha Motors on the index, which is also less than 1% higher right now. So that's not really indicating too much inherent strength. But Kunal, you're better placed to comment on this.
Yeah, so I think it's a zone for the markets, Ayesha, where the markets will have to digest a lot of different trends emerging, whether it's HDFC Bank on the upside, whether it's Infosys and IT sector downgrading, or maybe some pairing of positions over there. So we may probably see another couple of days where the markets may go into this adjustment mode, and that's why I think trading the index and finding out direction in this kind of a market would be a lot more difficult. So that's why we probably reduce the trades and look out for more of the patterns emerging. The stock which I would be looking out to trade at the open would be on Tata Chemicals. I think that looks attractive at the 1020 odd mark, and now confirming a breakout on the short term chart. So would be a stock which I would suggest to buy.